Hi, everyone. Welcome to Your Money Matters. I am Angela Giroux, your host, and I am joined by our esteemed experts, Ted Bauman and Clint Lee. Now, if you want more of their great insights, I invite you to join us at the Bauman Letter. There's a link above with details on an incredible offer that we've put together. Now, before we get into today's topic, I did want to apologize. I lost my voice yesterday, screaming my head off on roller coasters. Now I'm sort of screaming my head off today with a different roller coaster, the stock market. It's not nearly as much fun though, I gotta say. We've talked a bit about breadth in some of these videos, and we did want to hit on it today because it is important. You see breadth deterioration before a lot of major market declines and bear markets. And Ted, I know you spoke about this in your profit switch update this week. He talks about the current state of the stock market, that the S&P is hitting all of these new highs, but most stocks just are not participating in this rally. It's just a few strong stocks pulling up the entire market. So I really wanted to dig into that today, and let's look at some of those implications if we could.
Yeah, I mean, it's one of the most difficult times, I think, to be in the stock picking business, because people look at the indexes and they go, they're up. Why aren't all the stocks that you told us to buy up? And the problem is that, the stocks at the very top are very few. Here's a chart that shows the concentration of the top 5 stocks. That was at the end of last year. It hasn't changed a lot. But at this point, we are at just, a complete, just a total ahistorical, it's never been like this before situation with market breadth where we have such concentration at the top. So bottom line is they're about just under 23% of the market, those 5 top firms. Now, the problem is that if those stocks are going up, they're pulling up the market index, and you can have a lot of stocks going down without seeing it. And people are going, how do we understand this? Well, here's another chart that shows the S&P 500. I just want to start with, this is a 3-month chart of the index. And you can see that in the last, couple of weeks, basically, it's been a difficult trading environment. It's starting to pull back. I've circled that. I've also showed that the MACD indicator, thanks Clint, is also pulling back. So we're starting to see a pullback. And I think what's happening is that the number of stocks that are pulling back under the hood are starting to overwhelm the effect of the very top stocks. So in other words, there's only so far those top stocks can go before they start pulling back and pulling everybody down. Now, historically, when you get this kind of a scenario where you have very narrow market breadth, it predicts pullbacks. Here's a chart that goes between 65 and 2015, and it just shows a correlation between that bottom line, which is what we call the advanced decline line, which is the number of stocks rising versus the number of stocks falling. That when you see it fall, it typically precedes a pullback. It's a pretty reliable indicator. Now, here's another chart that shows where we are right now in the SPY, the S&P 500. And it shows that when you get into a situation where breadth is exceptionally low, excuse me, sorry.
Were you on roller coasters?
I caught it. I wasn't on a roller coaster, but there it is. Anyway, so you get these situations, and those are warning signs. And that warning sign flashed back in June. And I think what we're starting to see this last week, if you refer back to that earlier chart where I showed the pullback in the index, is that's the warning sign flashed in June. We're now starting to see the results of that. Now, going back further, historically speaking, this is a chart that Clint showed me this morning, and it's really remarkable. It shows that right about the time of the pullback, in the dot-com bust, the number of stocks that were trading below their that were in correction territory, basically 10% down, was at an all-time high. So think about that. It was over 80% of stocks in September 2001 were trading, 10% down in correction territory versus the SPX. And I think that's a critical symbol. So the question is, who's in that position right now? What kind of stocks are in that correction territory right now, which is a 10% drawdown? And which of them are opportunities?
Well, Clint, I had to say, there's not a lot of things that I miss about last year, 2020, but one thing that I do miss is that you could basically pick a stock and make it a winner. Now, unfortunately, right now, it seems like there's just fewer and fewer names pulling up the stock market. So, of course, the big question is always going to be, Is it time to get out of stocks?
It depends on where you look. So there's one area of opportunity that's opening up. With the pullbacks that we're seeing, and I'll get to that in just a moment. I want to go back to a point that Ted was touching on. He's talking about stocks that are entering correction territory. What type of how many stocks are 10% below their high? And here's a chart that shows we're not quite to the .com extremes yet, but it is surprising at how quickly this number is growing. So this chart shows across sectors, and then the blue bars, and then the yellow bar is the S&P 500 overall. And what this is showing is that 56% of the members in the S&P 500 are now in correction territory, or they've at least had a drawdown of 10% or more since May 1st. So that's the S&P 500 overall. You can see a similar number, that figure for the sectors on here. But what I want to point out is that if you look on the right-hand side of this chart, it shows for the Russell 2000 index, so small cap stocks, kind of a similar figure. You've got 90% of the Russell 2000 of small caps are in that correction territory. And then if you look all the way to the right, you can see that 55%, so over half of the Russell 2000 has fallen at least 20% from their prior high. So over half the stocks in the Russell 2000 small cap index are now in a bear market. So we've seen, rapid deterioration, especially in mids and smalls. That's the more cyclical areas of the market. They tend to respond first, whether it's the markets are deteriorating or issues with the economy, and that's exactly what you've seen this year. But something interesting is happening, and it's that it's pulling down forward valuations in these areas. So here's a chart that shows forward valuations for large, mid, and small caps. Large caps are the red line. Mid caps are the blue line, and small caps are the green line. This goes all the way back to 1999, just to frame up, kind of what the averages look like. And look how quickly this pullback in the mid and small cap space has pulled down valuations. Now, running at kind of historical average levels versus the S&P, or the large caps, the red line, has barely budged. And so that's creating a really wide gap between those relative valuations, and it's a gap that's approaching some pretty big extremes. And that's what you can see in the next chart here. So this line comes from Bloomberg. This line's a relative PE ratio of smalls compared to large caps. So when the line's rising, that means small caps are becoming more expensive relative to large caps, and vice versa. When the line's falling, small caps are getting cheaper relative to larges. And you can see that this line has been falling for almost a decade now, but has really picked up the pace to the downside this year, as once again we've seen this big pullback in mid and small caps. So putting it all together, what does this all mean? Does this mean this is the sign to get out? I think this is a big issue, especially if you're indexing. If you just hold a broad market ETF, with where we are, the concentration that Ted was highlighting in the top stocks, if those join the pullback, it is going to pull the entire market lower. But that doesn't mean you have to sell everything. With the valuations we're seeing in mids and smalls, and especially on the value side of the investing universe, there can be some great opportunities there with how the pullback's created. So, and just to illustrate a point to that, if you go back to when the tech bubble was bursting, if you look at how certain style boxes, we'll call them, performed in 2000 and 2001, that's very telling for how this could play out over the next couple of years. So here's these are called Morningstar style boxes. It looks at how large, mid, small caps and growth versus value performed. And I'm showing this for 2000, so early 2000s when the tech bubble burst, and then you've got 2001 as well. Overall, we associate the bursting of the tech bubble with just the overall markets collapsing, but that wasn't the story across all these investment segments. If you look, value stocks were outperforming, especially in the small mid-cap side. Mid-cap value in 2000 was up 24%, small cap value up 19%, versus large cap growth down 32%. But those growth names, it took up such a huge portion of the index that it pulled the entire market down. And you had a similar situation play out in 2001. So once again, if you're indexing, if you're holding a broad basket of securities, if those stocks start to catch up to the downside here, it's going to be a big issue for those holdings. But there's some great opportunities in the value space here, especially on the mid and small side.
I did also want to pose the question to the people watching. If you think it's time to get out of stocks, we want to hear from you in the comments, yes or no. But Clinton, you did mention a key word, and I want to hone in on it, opportunities. So Ted and Clint, if you could give us some opportunities, some ways to play this, I know the viewers would really appreciate that.
Well, yeah, and I just want to go back to the issue that one of my readers raised. That was the subject of my video earlier this week. He said, if the indexes are up, why is everything else down? And should we sell? Well, do you sell when stocks are down? You sell when stocks are down only if they're bad stocks. If they're just stocks that are being derated, if they're just being penalized by the market, because of short-term conditions that don't reflect the fundamental business and bull thesis for the company, then you buy more of them at that point. That's how you set yourself up for gains. So right now, what we're seeing is that the correction, for all intents and purposes, in small and mid caps has already happened. Sure, we're down on some of those stocks because we bought them earlier, not knowing that this correction was coming. We didn't know about Delta, all that kind of stuff. But now they're down, and now's the time to buy more of them. Lower your cost basis; they will bounce back, right? And that's how you make the big gains, is you buy in. So here's a couple of companies are really all over the place that I think we could look at. One of them is Simon Property Group, a big retail REIT. It owns retail property. It's had a torrid time of it during, this is their chart, it's had a torrid time of it during COVID. We can see that they really plummeted during the 2020, struggled to get back. They've regained a lot of that territory, but not all of it. And one of the critical things about SPG is that they've used this opportunity to strengthen their balance sheet, to weed out some poorly performing tenants and things like that. And so they're probably going to come out of this a lot stronger than they were before. So now is a good value point. They pay a reasonable yield. They're a REIT, real estate investment trust, and we like those a lot at the Bauman Letter. They tend to be resilient. So there's one I like. Clint, I know you've got a couple more.
Yeah, I've got a couple more. Another one to look at is Brookfield Renewables, ticker BEP. Here's a chart of that stock going back a year. They produce electricity using a portfolio of renewable energy assets. Renewable energy has just a phenomenal growth outlook, but the stock price, you're seeing a similar chart setup across. Especially once again, kind of the small and mid cap segments of the stock market, where we've pulled back and we're consolidating these big gains from last year, but that's creating once again great buying opportunities here. And so Brookfield BEP had peaked out around $50 a share, came right back down to trading right around the 50-day moving average right now, the black line on here. But just carving out this this basing pattern, this is just a healthy sign of consolidation before that a lot of stocks go through before resuming the uptrend. You can get a 3% yield on this stock here as well. And then the last one, this is one that's just been absolutely pummeled by the pandemic. If you believe that, there's light at the end of the tunnel, and we're going to get this return to some sort of normalcy at some point, look at some of the cruise line operators. So here's CCL, Carnival Cruise Lines. Took this back a couple years just to show how far below the prior highs we are. Had peaked out right before the pandemic at around $50 a share, still trading around $23. Look at $23 stock. Their earnings before the pandemic was as high as $4.40 a share. I'm not saying they're going to get back there, but even if they can recover half that over the next year or two, there can be some great value opportunities in this space as well.
Right. Yeah, and I just want to end off by reiterating what I said earlier a couple of times, is that when the stocks like small caps are down, that's the buying opportunity. It doesn't mean that you should stay away from the stock market. You just have to buy cheap so that you can sell high later. And I think a lot of people, we deliberately go fishing in that pool for stock picks. We have to, because that's the only way you're going to get the big gains. If you just want us to, to recommend that you buy Amazon or Google or Facebook or whatever, you don't need us for that. You can figure that out for yourself. The critical thing is, if you want the really big gains over the short terms, once we do turn the corner on Delta in particular, I believe, then that's where you got to go, and you have to persevere with it. If you run panic, you sell at the bottom and then you buy at the top again, you're making the classic mistake. We don't want you to do that. That's why we recommend look at these small and mid cap value opportunities right now.
So to summarize, the best strategy for investing, if I may, Ted, we want to buy low and sell high.
Well, I believe so. I mean, I think that's one thing to do. And of course, you can, in the short term, while we're waiting for things to resolve, you can also play options. And Clint's got a couple of brilliant option services that are delivering outstanding gains. And in that case, it doesn't matter whether the stocks are going up or down. You can play it both ways and make a lot of money doing it.
Great point. Well, thank you all for watching and joining us on this crazy roller coaster as we figure our way through all of it. Again, please comment below. Let us know what you think about these picks. Ted and Clint, thank you very much. And I'll speak with you next week.
Thank you.